I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Alex Canham, who's partner of Herrington Carmichael, where we continue our second informative question and answer series under our YouTube channel to provide top tips and market update when selling an IFA business and an insight into the legal processes when buying or selling an IFA business by two industry experts. The title of this mini video is coming up on screen now.
Gary, as part of any acquisition process, how will that impact my regulatory capital within my business?
Well, what we often find with acquirers is that they actually do the acquisitions through a topco, and the reason for that is so that when you're buying a business, you're buying the goodwill, and that goodwill is an intangible asset. So when you come to do your data reports and you look at the value of your business, you have to deduct any intangibles. And of course, if you've used your cash, then you've weakened your assets, or if you've borrowed money, it's increased your liabilities. So it's a bit of a double whammy there, and that can cause a problem with the capital adequacy in the business. So that's hence why topcos are really introduced for that very purpose, because they stand outside of the trading entity, which still can have a much more reasonable capital adequacy. So we often find with the topco, then there's particularly with vendors, is how do I make sure, because it's got no trading through the topco, how do I make sure that I get paid, that doesn't have any turnover? How do you protect a vendor in that situation?
It's a very good question, because these topcos are often just incorporated purely for the purpose of making the acquisition, and their balance sheets are not particularly strong. They've often got money lent into them via the group. The best way to protect it ultimately is to try and follow the money in the funding.
Yeah.
So looking at potential guarantees from the trading companies within the group, or potentially even from the funders who sit further up in the chain.
Fantastic. So Alex, can an acquirer adjust the consideration value if the market crashes or the income, particularly the recurring income coming through the business, isn't as what was expected?
In the main sale agreement, we tend to see a variety of adjustments that will deal with exactly those scenarios. So the first one is where there is an underperformance against the financial metric that they've set, whether that's expecting to hit a target of recurring revenue or EBITDA or assets under management or any other sort of variable that they've agreed between them. And the sale contract will say, if you are below, these are the consequences. And from a legal perspective, the key thing there is not so much what commercially you've agreed with the buyer to be that test, but is that it's unambiguous and it's completely clear. What we don't want to have is a scenario where people are debating what falls into recurring revenue as a definition or into EBITDA, because I know from experience that a lot of people think they're talking about the same thing, but actually when they get into the detail, they're not. So making sure that it's nice and clear what exactly the test is and what the threshold is and what the consequences of not hitting that.
Yeah.
On a market adjustment, those are a little bit more difficult because you have to link it to some sort of index. We do see them, not as much now as we did probably 3 or 4 years ago during COVID, when there was obviously a lot more uncertainty and instability in the market for that short period at the beginning. But you can build in mechanisms that will say if there is a set reduction in a particular index, that either the deferred is reduced in a particular way, or similarly from a seller's perspective, that it's not reduced and they are given some leniency, perhaps an extended period or some sort of way to ensure they still get paid the same because the client assets have remained under the buyer's and the group's management. Even though the recurring revenue appears to have dropped, they've still maintained those clients and that pool of assets. So there's a variety of ways that you can deal with an adjustment and a correction in that way.
And I often sometimes see that it looks like an average over the period as well, so that if it's just one of those periods, let's say the first year it drops, if it can regain it in the second year, then that corrects that as well.
That's right, and often buyers we tend to see are looking to earn a certain amount of profit or recurring revenue over the deal period, and most, I would say, are quite comfortable saying, as long as we get that over the 2-year or 3-year period, then ultimately we will make sure you would have got. The fact that it came in a little bit more lumpy than they would have liked,
Sure.
Actually they don't tend to penalise sellers for that, I would say.
No, absolutely. And how do I avoid the seller wanting to renegotiate deals after heads of terms? Heads of terms should have all that high level detail, that what the transaction is going to look like. But we do sometimes find that vendors or acquirers try to make tweaks, and it doesn't go down too well, to be honest. So how do you try to avoid that from happening from your side?
Biggest thing I often find the cause for that is because they don't quite understand some of the more legal concepts that they've signed up to. So they will often understand the financials and the kind of key operational bits, but the heads of terms can be very detailed or they can be very basic, and it really depends on the nature of the buyer and how they approach that. So I often encourage them to take advice from people who have been through the process before, and their lawyers, their accountants, their general advisors, and get that input from everybody at the outset, so that you're feeding in everyone's comments at the beginning of the process, so that whilst the heads of terms are being negotiated, you don't then get to a point where when they go and talk to their accountant or lawyer, they say, oh, I wouldn't have agreed to this, or did you know what this meant? And then they say, oh no, had I known, I might have approached it differently. And that causes them to go back and try and renegotiate certain positions. And often that's where goodwill can be damaged in the process, because the buyers have committed both time and resources to doing their due diligence and progressing the transaction on the basis of the heads, only for the sellers to come back and want a higher multiple, or to give no warranties and indemnities, or positions that actually are not that helpful. The other thing I think that's important is surrounding yourself with people who have been through the process in your industry, because there are lots of good advisors out there in all different sectors who have been involved in transactions of different shapes and forms. But understanding industry nuances is critical.
Yeah, I agree.
We talked about it earlier in terms of valuations, but particularly with financial services businesses, there is a degree of market standardisation around what assurances buyers expect on warranties and indemnities, what multiples are paid and the basis of valuation, and what they expect in terms of restrictive covenants too. So the minute that people try and introduce things that might be very normal in a tech deal or a manufacturing deal into an IFA transaction, it causes a lot of people to become a bit concerned, because ultimately that sets the tone for the transaction. And
often we find this, Alex, and particularly I think when a vendor wants to use a lawyer that they had as a client for many years, had a really good relationship with, but hasn't actually had any experience of IFA sales, and those type of situations can often lead to some really big issues, and trying to encourage a vendor shouldn't accept this, because I don't think in most industries don't have deferred sales like you do in IFA acquisitions, and almost demanding that the deferred payments are held in escrow, for instance. It's not going to happen. That's tying up capital. It is about looking at the bigger picture, looking at the overall business and the ability and the balance sheet strength of the balance sheet and the funding that's going to be in place. All of those things are absolutely fine to be asking to see, but there can be certain things that cause a deal to go sour because of almost asking for the impossible to be there.
I think that's right. It's sort of unrealistic expectations sometimes can cause those issues. I think if you do get to a scenario where things like that come up, it's about having a full and frank conversation with everybody, and I would always avoid back and forth between lawyers arguing over certain points, and actually getting everyone around the table and sort of having a frank conversation, because it will save everybody a lot of time, money, and ultimately is more likely to get things back on track. Yeah,
and I mean we've done that quite a few times, whether you've been representing the buy side or the sell side, and having your counterparty involved, and having both the vendor and the acquirer and ourselves as a broker, and I think it works really, really well. And actually getting that early as well, not when it's a bone of contention, literally what are the last few things to iron out, it can work so well.
Absolutely.
Subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in the series of top tips and market update when buying or selling an IFA business, and an insight to the legal processes by two industry experts, me, Gary Venner, CEO of one of the UK's largest specialist brokers in IFA Acquisitions, and Alex Canham, partner from Herrington Carmichael, who are leading commercial lawyers specialising in IFA mergers and acquisitions.